Did you know the money in your bank account isn't really there? This isn't a metaphor, and it isn't conspiracy talk. If every customer walked into their bank tomorrow and tried to withdraw their money, the system would collapse within hours. Not because of a glitch, but because the money simply doesn't exist in the way people think it does. This is not a flaw in the system, it is the system. It's called fractional reserve banking, the quiet engine behind global debt, inflation, and the illusion of wealth. Once you understand how it works, you begin to see that money itself is built on promises that can never all be fulfilled at the same time. To see how this began, we have to go back to a world before digital balances and banking apps. In medieval Europe, money meant gold and silver. Wealth was physical, coins in a chest, jewels you could trade, but carrying gold was dangerous. So people began storing their valuables with goldsmiths who had secure vaults. In return, the goldsmith issued a receipt promising that the bearer could reclaim their gold at any time. Soon people realized they didn't need the gold itself. The receipt worked just as well. It represented value and was far easier to carry. That realization changed everything. The goldsmiths noticed something important. Almost no one came to withdraw their gold at the same time. Out of 100 depositors, maybe 1 or 2 showed up on any given day. The rest of the gold sat untouched, so the goldsmiths took a risk. They began issuing more receipts than they had gold to back them. If they held 1,000 coins, they might circulate 2,000 claims. The extra receipts were loaned out at interest. Gold that didn't exist was now generating profit. As long as everyone didn't demand their gold at once, no one noticed. Money had been created out of thin air. This practice didn't remain a trick. It became institutionalized. Banks were born. By the 17th century, governments embraced the system. The Bank of England, founded in 1694, wasn't created to serve the public. It was created to finance a government drowning in war debt. The bank lent far more money than it actually held, and the debt was repaid not with conquest, but with taxes collected from ordinary citizens. The pattern was set. The same mechanism is used today. Governments borrow money that doesn't truly exist and pass the cost to future generations. In early America, banks issued notes redeemable in gold, but quickly printed more notes than their gold reserves could cover. Periodic bank runs exposed the illusion. Panicked crowds demanded their money only to discover it wasn't there. Banks collapsed overnight. Instead of abandoning the system, governments reinforced it. Central banks were created to protect confidence. The message was simple. Even if the money isn't real, belief must be preserved. Now let's translate this into modern terms. Imagine depositing $100 into a bank. You believe that money is sitting safely in your account. In reality, the bank keeps only a small fraction and lends out the rest. Under the old model, maybe it kept $10 and loaned out $90. That $90 gets deposited elsewhere, where $81 is loaned again. The cycle continues. By the end, your original $100 has multiplied into nearly $1,000 circulating in the economy. Yet only a tiny portion exists as actual cash. The rest is debt. And here's the crucial update. In the United States, reserve requirements are now zero. Since 2020, banks are not required to hold a single dollar in reserves against deposits. So what stops banks from lending endlessly? The constraint today isn't reserves. It's capital and liquidity rules, governed by international standards known as the Basel Framework. These rules were developed after repeated crises, especially 2008, by regulators meeting in Basel, Switzerland, at the Bank for International Settlements, the central bank of central banks. Banks must hold enough shareholder equity to absorb potential losses. If a bank wants to make a risky $100 loan, it might need to hold $8 of its own capital as a buffer. That's the real leash. But notice the shift. Banks no longer lend deposits. They create loans first, and those loans create deposits. When you receive a mortgage, no cash is pulled from a vault. New money is typed into existence. Only afterward does the bank ensure it meets regulatory requirements. That's why more than 90% of the money in circulation today is not cash or central bank reserves, but bank-created money, born the moment a loan is issued. Every dollar is someone else's obligation. This structure produces 3 unavoidable consequences. First, inflation. As credit expands, currency is diluted. Prices rise not just from supply and demand, but from monetary expansion itself. Second, perpetual debt. Because money enters the system as loans, total debt always exceeds the money available to repay it. Interest guarantees the imbalance. Someone must always borrow more, refinance, or default. Third, concentration of power. Banks earn interest on money they never truly had. Governments finance wars, welfare, and bailouts without immediate taxation. Asset owners benefit as inflation pushes prices higher, while wages lag behind. When confidence breaks, the illusion cracks. In 1929, banks collapsed by the thousands. In 2008, credit expansion through mortgage securities nearly brought the system down again. Each time, the response was the same: massive intervention, trillions injected to preserve belief. The system survives because it must. Across most developed economies, America, Europe, the UK, Canada, Australia, reserve requirements are symbolic or non-existent. Emerging economies may still use them, but Basel rules dominate globally. Everywhere, money creation is constrained by regulation, not vaults. Here's the uncomfortable truth: the system cannot function without debt. If everyone paid off their loans tomorrow, the money supply would shrink dramatically. Banks would stop lending. Economies would stall. You are not just a participant, you are the fuel. That's why money is not wealth. Real wealth is land, skills, knowledge, production, and independence. Debt is not neutral. Inflation is not accidental. These are features, not bugs. This isn't a call for panic. It's a call for awareness. When you understand how money is created, you can begin to step outside the machine. Ignore it, and you remain a player in a game where the house always wins. History doesn't repeat, but it rhymes. The goldsmiths, the bank panics, the financial crises, different eras, same structure. A system built on confidence, and confidence is fragile. So the next time you check your bank balance, remember, most of it exists only as a promise. Understand the system and you can protect yourself from it. Ignore it, and you remain trapped inside it. The story isn't over. If you found this interesting, don't forget to subscribe. See you in the next video.